So, selling an online business in 2023 has become in many ways more challenging than it was in 2020 and 2021. You're seeing valuation multiples dropping, you're seeing it taking longer for businesses to be sold in general, and certain business models have become far less popular as acquisitions when you're just comparing to a couple years prior. But all is not lost. In fact, things are even better when comparing just a linear trend from 2018 to 2019, and I'll get into that in just a little bit. But here's why I'm even telling you this. So we have business owners on the marketplace now and sellers who are waiting to sell their business or holding out for a specific valuation, and they're waiting for the right time to sell, thinking that it might be just around the corner. Well, I've put together some marketplace data and analysis of that data to kind of give you an idea of what the next couple of years might look like on the marketplace, and just to help you to determine if now or in the future would be the right time for you to sell. And if you want to know how to deal with these falling estimates and just these longer sales periods and still sell for a good price, then stick with me until the end of the video. So my name is Nick, and in this channel I help entrepreneurs buy, build, and sell online businesses. So over the last 5 years, we've actually sold over 1,400 online businesses. And I've actually recently looked at some of the marketplace data and looked at the trends from 2018 to the current state of the market. And we've tracked all of the different types of businesses that we sell, from Amazon FBA, e-commerce, content sites, Amazon KDP, SaaS businesses, apps. And if you've recently tried to sell your business, you might have noticed kind of a shift in the buyer's market, or just what the marketplace atmosphere seems like or feels like compared to 2020 and 2021. For example, this is a trend that I'm pulling up on the sales volume from 2018 to 2022. And you'll notice on this chart a very clear spike in 2021 and then a sharp drop in 2022. Now, you will also probably notice that the overall sales volume in 2022 is still higher than the pre-pandemic time periods. So we're still seeing a linearly progressive increase, but here's the reality on the ground that we're seeing for you as a seller or as a builder, somebody who might be considering selling in the future. We believe the market is normalizing after a 2021 peak, and this peak is more prominent for certain business models, and we're going to be coming out with a state of the industry report very soon to break down how the different business models have performed over time. But one thing, regardless of the business model, one thing we're seeing is that we are likely, very likely, at market normalization, and we're not going to be returning to the levels that we saw during 2020 and during 2021. Now, the reason why I say that is because for market conditions of 2020 to 2021 to happen again, we would need to see pretty much a combination of three scenarios. First is we need to see a world-changing event, such as a pandemic, an event that has the effect of shifting online buying patterns to where this suddenly makes a specific business model a very attractive type of business to own, to the point where suddenly a specific business model becomes far more profitable than it was before. And in the case of 2020 and 2021, that was e-commerce businesses, specifically Amazon FBA. And this happened because everyone was indoors and purchasing physical products online became really the only option for a lot of people, and a lot of brick and mortar businesses even went out of business. So you saw a huge shift in the market purchasing more and more products online. So that's the first part. The second point are highly liquid aggregators. So having a large buyer pool who is funded by, in this case, we had Amazon FBA aggregators who were funded by traditional investors to then go out and acquire these Amazon FBA businesses. So there's a couple things there. First is this type of business model, whatever that new business model would be, it has to make sense both from the online business buyer's perspective, but also to traditional investors or those who fund these buyers. So you can imagine what kind of metrics that they're looking at. They have to be able to make a significant return on their investment when comparing to other assets that they could be investing in. And talking about alternative investments, that leads me to point number 3, which is where the alternative, less risky assets need to be less desirable at that time than this online business model. Let's talk about during the pandemic. So real estate is traditionally perceived as a less risky investment because it's a physical asset. When compared to Amazon FBA, you are essentially at the mercy of Amazon's terms of service because they can decide to shut down your listings and your business altogether overnight. And that's a fact that a lot of experienced Amazon FBA sellers are aware of, but that's just not really the case when you have a physical location. So during the pandemic specifically, owning real estate became, and renting that out as a rental property became a less desirable acquisition or less desirable investment because of the laws passed during the pandemic that gave renters more protections to where they couldn't just be kicked out if they stopped paying. So the perceived risk of a traditionally less risky asset increased, and therefore this type of online business became the more desirable acquisition. So it's really the combination of those three: the business model becoming an ideal business model, traditional investors coming in to back buyers to purchase this business model, and then the alternatives being less desirable all at the same time. Now, the likelihood of all three of these scenarios playing out within the next 1 to 10 years even, we think that's very unlikely to happen. So we don't see prices and the market conditions returning to the pandemic levels. So now to add to that, this potential recession and the fact that buyers are less willing to spend money in general, or they're being more careful about the investments that they make. And we're now in a different market. So despite this, I mean, if you're a seller, you probably already are aware of this because you've maybe gone through some sales conversations, some buyers have backed out, some buyers have not agreed with your valuation. Now, despite this, a lot of the sellers on the marketplace, they're actually continuing to list and kind of go through these negotiations, living within the 2020-21 era and kind of being firm on their decision to hold out on a specific valuation level for when the supposed wave to return. Now, holding on to the valuation expectations of the past is creating this misalignment on the marketplace between buyers and sellers. And this is an issue because it's creating distrust ultimately between buyers and sellers during negotiations. And that's leading to increased on-market times for these businesses, or these deals just not going through at all. Now, to illustrate this point, we've tracked the average days on market for each major business model from 2018 to 2022. And you'll see that in 2021, e-commerce businesses, they sold on average within a little over 33 days of being listed on the marketplace. So about a month of once you list it, it's sold. Now from 2021 to 2022, that length of time almost tripled to 91 days on the marketplace. And that's a return to around the 2019 time period. And some businesses did see a greater increase and some saw less of an increase in terms of having a shorter time on market. But you'll notice that all of the business models, they did increase to a certain extent. And in fact, 2022 marked the year for the highest days on the market for every business model. So what this is indicating is more buyer resistance or hesitation in purchasing for a certain reason. So it's clear that this has become more of a buyer's market. And because of that, sellers now need to be more flexible and be more willing to see eye to eye when it comes to negotiations with buyers. So part of that is being flexible on the actual price of the business, the valuation multiple. But another way, if you're still having trouble as a seller getting the deal across, you can leverage deal structuring in order to make your overall sale a more attractive acquisition. So one tool that sellers actually have in order to reduce buyer hesitations and make a deal more likely to get across is by leveraging an earnout as part of their deal structure. So an earnout means anything that isn't 100% of cash up front when a buyer pays for the business. Now, an earnout can be either a fixed earnout or a performance-based earnout. So a fixed earnout is where it's not based on performance. It's, for example, 80% of the deal is paid out for cash up front, and then 20% is paid out over time, maybe one payment per month for 6 months. Now, a performance-based earnout, as the name suggests, it triggers based on hitting certain performance metrics with a business. This is usually based on hitting revenue metrics. So, for example, you have 70% paid out upfront in cash, and the remaining 30% paid once you hit a specific revenue trigger. Now, earnouts are becoming more common for certain business models and for certain business sizes, I should say. So we've actually tracked this from 2018 to 2022. So you can see here that in 2021, e-commerce business deals saw the highest number of earnouts of 51 earnouts, and this actually dropped to 41 earnouts in 2022, but we think this is mostly because we just had fewer e-commerce businesses sold in 2022 compared to 2021. And content site businesses actually saw the opposite, where they saw more earnouts in 2022. And we think that for a similar reason why e-commerce businesses saw fewer earnouts is because we started to sell a lot more content sites in 2022. Now, as far as earnouts by the sales price tier, you'll notice that for the businesses under $300,000 in valuation, those were the ones that had the least number of earnouts. So typically what you'll see is the higher the valuation, once you get into the 7-figure level, that's where it's definitely common to have an earnout associated with your business. So if you're wondering kind of if your size of business justifies having an earnout, or if a buyer is likely going to want to or expect to have an earnout as part of the deal, this is kind of one way to think about that, is by looking at what your valuation is. And we actually have a free valuation estimator if you want to check that out. I'll leave a link in the description below, but this is a good way to kind of know that you'll be entering negotiations with this in your back pocket. And if you want to discuss with our sales advisors during this time period, we actually help to negotiate the earnouts, and we can propose specific earnout deals depending on the type of business and the size of the business. And that actually leads to the next thing that I wanted to talk about, which is insight directly from our sales advisors about earnouts and just about the market right now. So among the many roles that our sales advisors perform for buyers and sellers, one thing that they do is to help structure earnouts and just the deal itself. So one thing they told me was that for the sub $1 million businesses, those earnouts do tend to still follow that kind of like the 70-30 or 80-20 type of earnout structure, as far as cash up front and the remaining being paid out as an earnout. A lot of them are non-performance based, so they are guaranteed earnouts. And we're seeing actually non-institutional buyers as well as mini aggregators making these kinds of deals. So with, I think, the larger aggregators being less active in the space, there's less competition. So you are seeing that there's more room for these other players. And this is allowing for just longer conversations. So you are seeing more of these earnout negotiations happening. And in some cases, you're seeing this go as low as 50% paid cash up front, 50% paid out over time. And for these mini aggregators who are purchasing some of the larger deals, you are seeing that they're leveraging other funding companies like Bupos, who offer funding for e-commerce businesses. So they'll be partially funded that way, and then they'll pay the rest in with their own capital, and then leverage an earnout in order to pretty much get the deal across. So perhaps the most common question that sellers, business owners right now are asking is, when is the best time to sell? With most investments, it's impossible to predict the peaks, whether you're talking about stocks, cryptocurrency, even real estate. So if 2021 and 2022 was historically, in hindsight, the best time to sell, then the second best time to sell, or what is now the best time to sell, is today. And this is because regardless of how the market fluctuates, our advice on when the best time to sell is still the same. It really comes down to you and what you're trying to achieve through the exit of your business. Whether you're trying to retire, buy a house, open up capital and time and energy for another business adventure, start a family, start a new chapter in your life, those should be the reasons for making your decision to exit. If you feel like you're able to exit, and by you exiting, you will be able to accomplish the thing that you set out to do by starting this business, then you should consider exiting your business, because you'll be able to guarantee that that outcome does happen, assuming you are able to sell the business now, rather than potentially waiting for something that could never come. So the real question to ask yourself is, given the size of your current business, could you sell that business for an amount that could meaningfully move you forward, or altogether help you accomplish a life goal that you are trying to accomplish through being a business owner? If the answer is yes, but you are trying to figure out still more of the logistics of selling, when exactly might might be the right time to sell. Maybe you still do have some things that you need to prepare to make your business actually a more successful exit. I highly recommend speaking with our sales advisors. They'll talk you through what you would need to do step by step, maybe over the course of half a year to a year, if you need that much time to prepare to really set yourself up for a successful exit. Similarly, if you're looking to acquire a business, our sales advisors can also talk you through what's on the market right now, what kind of things you might need to prepare, who you are, what your skill set is, what your goals are for acquiring this type of business, and they'll be able to make a recommendation and of course help to negotiate on your behalf all throughout the entire process. And those who get on these calls have found them to be incredibly helpful, regardless of if they decide to buy or sell a business after all. And our audience who has decided to speak with our sales advisors have found these calls incredibly helpful, regardless of if they decide to buy or sell a business. Now, if you own a foreign website, then I do have good news as well, because we're now accepting foreign content sites to be sold on our marketplace, whereas previously we were only selling English-focused sites. So that's huge news for you if you are a seller. If you want to see more details of that, then click on the video here. So that's all for now. Thanks for watching. See you in the next one.